Welcome to a fantastic edition of Rebellion's educational series. I have Julia Bonafede with me. Is that the correct pronunciation?
Yes, it's great. Thank you.
Oh. Now, Julia is an investing legend. We're talking with the former president of Wilshire Associates, who has gone on to start a really fascinating company that I've been following now for the last few years, Rosetta Analytics. Julia, please tell us about this new firm of yours.
Well, Rosetta Analytics, we're an startup asset management firm. We have built an exciting AI platform. We use deep reinforcement learning to actually manage our investment strategies. So what that means is we've built a deep reinforcement learning model, and the inputs are the particular market that we're investing, and the model will take in those inputs, will make the allocation decision, and then we trade exactly what the model says to trade in the allocation it says to trade. And we've done that in two markets where
What are your markets you're focusing on?
we're trading S&P E-mini futures, and we are trading European carbon futures contracts.
Really? That's very cool. So tell us how you got the idea for this.
Well, it really germinated, but between my partner Angelo Calvello and I. We've both been in the institutional investment industry for many years, and from my standpoint, I spent a lot of time, obviously, as president of Wilshire Consulting. I was responsible for managing investment teams, consultants that advised allocators, so public pension funds, corporate pension funds, endowments, foundations, and we spent all of our time analyzing portfolios and making sure that they were efficiently designed to match both the return and risk objectives to meet their whatever their obligation was, their liability, whether it was to pay benefits, whether it was to fund research or fund a building if it was an endowment, whatever their program was. And so the early part of my career, I don't know if you know that Wilshire has built portfolio analytics software since the beginning. That was how Wilshire started. And part of
So
those
are you guys looking to make longer term predictions or shorter term predictions? I mean, it's 30-day, 1 day.
Well, that's the interesting part, Alex, because um, from your work that these models tend to be shorter term in terms of the predictions they make, but reinforcement learning in particular is built to make sequential decisions, and so it optimizes the reward going forward. Looking at the horizon in the market that it's investing in, and it makes decisions based on how it is learned to maximize that reward and be penalized when it makes incorrect decisions. And so while the allocations are for the next day ahead, it actually is building on all these past decisions to make a longer term move in the market, similar to playing chess where you're looking 3 or 4 or 10 decisions ahead.
It's funny, Julia, you mentioned chess because one of my good friends, Gordon Ritter, who's another teacher, he explains reinforcement learning as the act of knowing when to give up a rook for a queen, and that knowing that you have to make the short-term decision so that you can make a more valuable longer-term bet. So James Simons' Renaissance Technologies has a 2-week holding period, and most reinforcement learners I've come across tend to have 10 to 20 day. And by the way, I have to say, I run research now at about 6 schools, and creating alpha with reinforcement learning is something that we've been able to do with both natural language processing as well. So there's a lot of alpha that can and will be generated by this technology. And it can be used in various markets to do various things. So what do you kind of see as the future for this technology? Where do you see it in 5 years, Julia?
Well, so the software, speaking about it, Wilshire, it was mean variance optimization and performance attribution. and frankly, risk models. And so you've seen the evolution in the industry where asset managers, they make decisions based on their market views and then allocate in how much to bet on each of these views within those portfolios. So how much risk they're going to take and how much conviction they have. Reinforcement learning, first of all, has the ability, a neural network has the ability to look at patterns in using millions of parameters rather than a very static framework that is typically used in the investment industry. So the typical factor model, some of the more well-known ones have between 3 and 6 factors. There are can be as many as 80 factors at any given time. Well, the models that they use to really detect those patterns, have a lot of limitations, and their frameworks are only as narrow as those factors. As you know, with a neural network, you're going to look at data in multiples of ways. In reinforcement learning, has the optimization process that can actually account for those changing dynamics underneath in terms of the signal that's being detected, and optimize on multiple levels at the same time. So you're not just looking at a narrow set of inputs in a point in time.
Julia, I love what you're saying, and your term changing dynamics is very apt for the market that we have entered. The one thing I've seen over the last 20 years is a speeding up of almost everything in the financial markets. Time, information, everything's getting disseminated much more quickly. And so the ability to react is so important. I was first attracted to machine learning when I was programming for Neuberger Berman partner Laura Sloat in the late 90s. I kept finding that valuation factors fell apart during times of economic malaise. And I thought to myself, how can I access a system, build a system that can look at both the underlying economics while focusing on the fundamentals at the apropos times. So that's why I've been following Rosetta now since you guys started, and I think you're doing absolutely fantastic stuff. And, I hope the Rebellion's able to, if you guys want to share your white paper with us. The Winklevoss twins actually just shared their Gemini white paper, and we're happy to publish that. And, when I see a really brilliant idea, I get very excited about it. It's definitely fantastic work, Julia. So these are short shows are coming to the end here. Would you like to have some parting thoughts to potential customers who should be accessing Rosetta? Institutions, individual investors, people with $20 million in the bank?
Well, the important thing to remember about what the strategies that we're managing is they don't have an entry point. And so right now in the markets, if you're an institutional investor and you have a strategic portfolio, you probably have an allocation that's an absolute return, and trying to rebalance into that segment can be very expensive when assets are priced where they are. Reinforcement learning that drives our strategies does not have an entry point. So you can enter into a portfolio or into one of our strategies without worrying about where the market is at any given time, because it's making its decisions based on the environment that it has. And so its risk profile is to add alpha, and it does so at a much lower return. And so it's a liquid strategy, and it's going to give you the diversification that's required in markets like this. And I think that's where
diversification for me has become the most important individual feature of any investment thesis going forward. You just need to diversify, whether it's from private equity or whatnot. You really have to keep your exposure as diversified as possible. Everything moves in cycles now, and these exaggerated cycles are, with what the Fed's doing, becoming more and more apparent. So
exactly.
Anyway. So anyway, love that you're a USC alum. I've got a lot of family members who have taught there, and so big
wonderful.
fan of it.
I probably was my professor then.
Wonderful. Well, Julia, you have a great weekend. Thank you so much for coming on.
Great. Thank you, Alex.
I wish
Appreciate
you all
it.
the best. Oh, my pleasure.